Hey guys, welcome back to another video. My name is Josh and today we'll be looking at how we can value companies in 2019 using the market-based approach, or more commonly known as the market multiples approach. The market-based approach is a commonly used technique used by Wall Street analysts to compare the value of a stock to another similar stock within the same industry. So in this video, I'll go through what the market multiples approach means and the pros and cons of the market multiples approach, as well as we'll see how we can apply this method to a stock like Facebook, and we'll compare it with other tech stocks out there to see whether Facebook or not seems a bit overvalued or whether it seems undervalued compared to its peer firms. Right, so we'll do that's basically what we call a peer group analysis. So the market-based approach basically uses a variety of valuation metrics to come to a understanding of how much the stock is valued at, whether a stock is cheap or expensive. And in this video, I'll be comparing Facebook with other similar big tech stocks. So comparing it with Microsoft, Apple, Google, and Amazon. And we'll ask the question, is Facebook cheap relative to other tech stocks? So let's have a quick look at the pros and cons of this approach. The pros is that it's very simple and easy to understand. And why is that? It's because you get all your information publicly available on company websites, or you can source it from Yahoo Finance. And it's a very quick way to get a feel of the valuation of the company. The cons are that its effectiveness depends on the comparability of the companies. So for example, it has to be in a similar industry, similar in size and similar in business model to sort of get the most effective comparison. Right. The next thing is that it makes broad assumptions of the companies that sort of says, all right, we're comparing these two companies and we assume that everything within the businesses are similar. So we're sort of giving them characteristics that make them similar, which might not necessarily be the case. And it's not a substitute for detailed analysis. This is just a first look at a company and to see, sort of get a feel if they're over or undervalued. And if we want to dig deeper, then that's when we go on and examine the intrinsic value of a company. We do what they call a discounted cash flow to calculate all the cash flows of the business, what it's worth today, right? So the market-based approach is a very good first step to take when you want to figure out which companies to do deeper research on. So let's look at the application of this valuation method. So I took all the information from Yahoo Finance, all the key valuation metrics, and this is data sourced from Yahoo Finance as at the market close of 26 September 2019. And the data might differ from other sources depending on where Yahoo Finance sources their info from. And just a disclaimer, this is not a recommendation to buy or sell stock in any of these companies. And I do own Facebook and Google stock. If you require financial advice, do seek advice from an authorized financial advisor. So let's get into it. So the first thing we'll look at is the share price. The share price basically shows you how much you pay today for one share. And the share price is based on future expectations. So if a company is going to grow next year, then people are willing to pay more for it this year. But if the company is expected to decline this year, then you would expect people to pay less for it today. Just looking at the share price itself doesn't really give us any useful information. Sure, we know Amazon is worth $1,700 per share, and that's what we have to pay today to get one share. And we can see that Microsoft is $139 per share. So does that mean Microsoft is cheaper than Amazon? Well, not quite, because the share price doesn't link the shares to earnings. So how much would one share of Amazon stock earn you? And because of that, share price by itself is not a useful indicator of value. And what this tells me is nothing. And a very famous investor called Warren Buffett once said that just looking at the price is not investing. right? So you have to dig deeper into the company to check out its earnings to see whether the business is fundamentally sound. And you have to do all that to derive a true value of the business. Just looking at the share price itself doesn't give you a good indicator. Right, so the next thing we'll look at is market capitalization. And this is calculated by taking the number of outstanding shares multiplied by the price per share. So this is the equivalent of taking everyone's shares, everyone who owns Facebook, take all those shares multiplied by the price, and that's the market capitalization. And so as you can see, market capitalization of Microsoft is actually larger than Amazon, even though the share price was the lowest out of the 5 in the previous slide. And this is an indicator of the size of the equity value of the business. So with this, what this tells me is that Microsoft is the largest and Facebook is the smallest out of the 5. All right, next we'll look at enterprise value. Enterprise value is basically calculated by taking the market capitalization less any cash, and we add on total debt. And so as we can see here, the enterprise value slightly differs from company, and it's not equal to its market cap because we strip out the effect of cash or debt. And this measures the company's total value. And what this tells me is that all companies have strong balance sheets. They have no or low debt. So for example, if we look at Facebook, the enterprise value is 418 billion, whereas its market cap is 513 billion. So that means they have about 95 billion odd in cash and no debt. So that means there's a very strong balance sheet there. If a recession does happen, then chances are that they'll be able to survive it because they wouldn't have to pay off any outstanding interest on their debt because they have none. And we can also see that Apple and Amazon have a little bit of debt, but that level of debt is not concerning. So overall, these 5 companies have good balance sheets. So next, let's take a look at the price to earnings ratio. So this is the link to earnings with the share price. So we calculate this by taking the price per share divided by the earnings per share. And as we can see here, Amazon has a extremely high PE ratio. That's 72 times today. And Facebook has a earnings ratio of 30 times. Apple has the lowest of 18.67 times. Right, so share price divided by reported earnings per share. So this includes one-off gains or losses as well. So for example, if a company had to pay a fine like Facebook, that will be included in the price to earnings ratio. And I'll show you later on how we can get a better understanding of the business by using an adjusted earnings ratio. So stocks with the high PE suggest that future expectations are high and or there's a low risk in that business as well. Lower risk stocks tend to have higher PE ratios because their earnings are more sustainable and their business model is harder to compete against. Otherwise, it could also mean that there's high future growth. So for example, if we look here, Amazon looks like it will have the highest growth out of the 5 companies. And I also added the NASDAQ 100 and the S&P 500, which are your broad-based indexes. NASDAQ is more of a tech index. So as we can see here, Apple with a PE ratio of 18 times is a lot lower than the NASDAQ average. And Facebook seems a lot higher than the 2 index as well if we don't include Amazon. So Facebook does look like it has also a higher PE ratio compared to the industry average. So what this means is that you'll pay 30 times of today's earnings for one share today. And like I said before, PE ratio depends on the industry, and be careful of any one-offs as it distorts PE ratios. So next we'll look at the adjusted price to earnings ratio, which gives us a better understanding excluding all the one-off events, because we know that next year chances are that there wouldn't be any of these one-off events. The price to earnings ratio is calculated as price per share divided by adjusted earnings per share. So Facebook has a price to earnings ratio now adjusted for one-off events of 22.2, which has decreased from the earlier slide of 30 times. And Microsoft has now a higher PE ratio, slightly higher, because we adjusted for these one-off events. So Facebook had a one-off event of a loss of $6.1 billion. So this relates to $5 billion relates to a FTC fine, and $1.1 billion relates to income tax losses, right? And so Microsoft had a one-off gain that was a result of a net $2.6 billion tax benefit. So if we strip that all out, that gives us a more accurate picture of the price to earnings ratio. And what this tells me now is Apple still appears to be the cheapest and Amazon is the most expensive. But like I said before, now the Facebook stocks appear cheaper than the Nasdaq and the S&P 500 index. One of the shortfalls of the adjusted price to earnings ratio is that the earnings used in the calculation is based on the current year earnings. And if you remember earlier, I mentioned that share prices are forward-looking. And so when we want to get a more accurate picture of its future earnings and future share prices, then we should use what we call a forwards earnings ratio. So the forward price to earnings ratio is calculated using the price per share divided by next year's earnings per share. And so I've put here in orange the forward PE ratios. And like I said, as share prices are forward looking, this provides a better comparison of what the more accurate PE ratio should be. And it also excludes all the one-off events because that's not expected to recur next year. And so from the looks of it, what this really tells me is that all companies are expected to have earnings growth. As you can see, the orange bars are all lower than the blue bars. Right. And as you can see here, the PE ratio for Amazon has contracted significantly from 72 times to 52 times. So note that forward earnings is only based on 1 year, but say if we want 5 years, then we have what we call the PEG ratio, which is PE to growth. And we calculate this by taking the PE ratio divided by the growth rate, the earnings growth rate of the stock. I've included the PEG ratios of the 5 companies as well as the next 5 years earnings growth. And so this ratio takes into account expected EPS growth based on analysts' forecasts. And typically a good PEG ratio is less than 1. Anything above 1 to 2 is decent value, and anything more than 2 appears to be a bit expensive because you're paying a high price for low growth. And what this tells me is that Amazon appears better value than Facebook. So Amazon has insane growth, right? 83% expected growth for the next 5 years. And so when we take into account this growth, Amazon appears to be cheaper because their PEG ratio is at 0.9 times, and Facebook now is 1.3 times. And we can see here, Apple in the previous slide appeared to be the cheapest with the lowest PE ratio, and that's because they have the lowest growth rate of 9.68%. And so like I mentioned before, higher PE equals usually higher expected earnings growth. And we can see that here because Amazon has a very high PE, but also has a very high expected earnings growth, whereas Apple has a lower PE, but they also have the lowest earnings expectation growth. The issue that I have with the PEG ratio is that you have to sort of decide whether the earnings that analysts forecast, whether they're reasonable or not. So for me, the 83% EPS growth for the next 5 years for Amazon appears to be overly optimistic. Well, what if analysts are wrong here? If analysts are wrong and expectations are not met, then expect a large drop in the share price. And that basically means that the PEG now, today, is understated. So maybe the more accurate PEG is higher than 0.9, right? So that's something that you have to consider. So now let's put it all together. Apple is cheaper in today's earnings than Facebook, but isn't growing as fast. And this makes sense because we know that Apple is mainly generates their revenue from hardware sales, and hardware sales are slowing down. It's a declining business. And so there is lower growth there. On the other hand, we have Amazon, which is expected to grow faster than Facebook, but it's a lot more expensive today. And this makes sense as well because there's high growth of e-commerce and cloud services business. But the issue is I'm skeptical of Amazon's 83% EPS growth rate for the next 5 years. And so what does this all mean? So from this analysis, what I can gather is that Facebook appears the cheapest out of all these stocks, and Amazon warrants for further research to verify that 83% growth. So I'll have to dig deeper into their 10Ks and 10Qs, their annual reports, to sort of figure out whether they can achieve that 83% growth. Just before I close off the video, I just wanted to end with some remarks that the market-based method is the first step approach that you'll take, and the next step is really to look at the key drivers of the business and do intrinsic analysis, and valuation is more of an art rather than science. What I mean by that is that the numbers might say one thing and you might do all your calculations and say this stock is a buy, but share prices might behave in the opposite to the numbers. And so it's important to make sure that when you do research, make sure that your research is robust and always invest with a margin of safety, just in case that your research was wrong and stock prices drop instead. Then investing with a margin of safety will help you reduce your losses. So I hope you found this video useful, and if you enjoyed this video, please make sure to give a thumbs up and subscribe to start compounding your interest today. Until then, take care.